Hello world and welcome back to another vlog, and today for you we are analyzing the Tesla Q2 earnings. A shock for the market, minus 15% as of this recording, and I watched for you the conference call. And I watched several hours of video of different YouTubers such as Financial Education, Hyperchain, CNBC, and I read the whole shareholders letter of Tesla, and I want to summarize it. And one of the most important thing for this vlog is though I'm a convinced Tesla shareholder, I created actually a very informative graphic where I put opposite the arguments of the bulls and also the arguments of the bears, and want to analyze both sides according to the Tesla Q2 earnings, apart from each other and as neutral as possible, and then you can decide on your investment decision on Tesla. So let's go! Okay, we start with the basics. All you need to know, following. So, loss per share according to the Q2 earnings is $1.12 versus 40 cents expected. That's, almost triple that much loss than the market expected, analysts expected per share. Revenue almost on point, a little bit less with 6.35 billion versus 6.41 billion expected from the market. As a comparison, we had almost $3.06 loss per share last quarter and 4 billion revenue last quarter, same period last year. So improvements over there. Although there's still loss in this quarter, there is the guidance from the management there. They want to still produce 360 to 400,000 vehicles this year. And Tesla delivered around 158,200 cars already to his customer in the first 6 months. So, if they just double it, it won't be enough. So they have to produce much more, which they also state in their shareholders letter. Then that they produce much more Model 3 cars, and they are run rate of vehicles Model 3 per week already at 7,000. So that's a good sign. And towards end of the year, they will be able to produce even 10,000 Model 3 vehicles per week. So this is what can be also said. Also, another important part of the earnings was that they capex, so company spending, the cost for the company, they reduce it, which is a good sign, because they said that they want to spend maximum $1.5 billion versus expected of $2.4 billion. That's roughly 60% less. So that's very good, and all of this will be enough to fund Model Y development, as well as supercharger extension network, and also the Gigafactory in Shanghai. Very, very important point, which we'll go into it. And on the bright note for Tesla, also a very, very big cash position of 5 billion, though it has to be reminded that almost half of it, $2.4 billion, is what they raised just recently with a convertible note and equity as well. So stocks, though they had a very good 614 million free cash flow in this quarter. On the whole year, though, you can see that stock had as closing of Tuesday this week, so the 15% that they lose now have to be added to this 22 decline of stock price only this year, and this is already very heavy for shareholders. and there is almost 19% of margin, which is declining over time on all the cars they produce versus 20.6 in the same quarter last year. So this is good food for the short sellers, of course. But let's dive into my graphic that I just did for you, where I want to very, very neutral look in both arguments, bears as well as shareholders and bulls of Tesla. Alright, so the bears have to say that the margin fall from almost 19%, so 18.9 to from 20.6, so there's a decline in margins. They say, it cannot be that Tesla get profitable. Then they say that sales of X and S models start to decline or declining already. The CTO and co-founder of Tesla is leaving. Yes, he's going into an advisory role. This was announced on the call. And they also have a big argument on the beer side that there's no profitability in this quarter, though they have record numbers of sales and delivery. On the other side, the bulls of Tesla and shareholders says, hey, we have 60% revenue growth from year over year. So last year at the same time, they make 60% less revenue. This growth number is extensive. Moreover, Tesla had the record sales in cars, record delivery in cars, and also a record in battery slash Powerwall sales, which is also, good to mention. They have a record positive cash flow of $614 million. They had never more cash on hand before. And the CapEx guidance for this year, actually they said, hey, we would need $2.5 billion this year. But actually they really want to spend $1.5 billion, which is 40% less. So just digest this, 60% more revenue and 40% less cost. So think about that, all right? Then we go to the beer side. The beers saying that, the shares are down already 30% or more this year, with today, of course, very bad for the stock. Coming competition, which will come from VW, Ford, and all these other car manufacturers, the Chinese, NIO, and so on and so forth. The solar business is very low, minus 65% year over year. The solar business is not great for Tesla. The total liability, okay? And now hold your seat, because total liability for Tesla, long-term, short-term, everything is $32.8 billion. So that's quite huge. And also they have a big argument with these numbers, of course, that the revenue expected by the market and analysts is missed. On the other hand, the bulls come with the good news that China Gigafactory, which will be a growth for the revenue of Tesla, will be opened end of this year already, which is very, very good news. Elon Musk want to break even with the company in the next quarter, and then from then onwards, Q4 should be profitable, and since then they want to stay profitable. The guidance are short for 360 to 40,000 cars this year, and next year they want to already produce over 500,000 electric vehicles. That's a record number for any company in the world. And they confirmed that Model Y is on time to be ready to be delivered and produced in fall 2020, and they see a almost double the market for the Model Y than Model 3, and they can produce the Model Y very, very price competitive, because most 75% of the parts of this car is used also in the Model Y, so they can, buy much bigger quantities of the suppliers and reduce price and also increase maybe margins. We don't know, we will see. And one important point, and this is the last one from the bull side, that the Elon Musk and his team, also the new CFO Zach, confirmed that from now on Tesla will be a self-funded company, and this means that from now on they don't need to raise any capital. They don't need additional capital, so they will grow from their revenue, from their margins, from their profit they will do from their cash flow, and don't need external money so far, which would be a turning point in the Tesla history. Alright? I tried to summarize both sides very, very neutral, though I want to, as a final conclusion, make my own thoughts for you as considered. I'm a Tesla shareholder, and I will let you know what I'm thinking about these arguments as well as the quarter two numbers. For me, there is a very, very important point here in these numbers that I see is that the revenue continues to grow and the capex almost stays still. So what does it mean? It means if Tesla continue, and this is the guidance, that they will have increasing revenue and exponentially growth of revenue, they will have the same capex, so that means that they will get profitable and more profitable over time, and the losing margins on the cars is obviously a change in the product line of Tesla. Tesla is becoming from the niche electric car manufacturer to a massive car manufacturer like Volkswagen, so they become like a specialized car company like, let's say, Lamborghini, to a VW, and of course the margin gets slower while they producing much more vehicles. And this will be the key that, the Volkswagen of tomorrow could become Tesla with the revolutionary change of electric vehicles. This is also the story if you're a long-term investor as me, and believe in the story and the execution team of Elon Musk, then you basically stay with this company because you think that, with self-driving capabilities of the car and the software side that Tesla will sell with huge margins, they can become a very, very profitable company in a couple of years. So we see maybe a turning point. So this 15% dip could be a good investment idea right now, but who knows? We will know when on the other side the grass is greener, as you know. And if you're new here, subscribe, hit please the thumbs up button, because this will help me to grow my audience here on YouTube, and I'm vlogging daily about stocks and other companies that cross my mind and then I see in the news. So all this value I want to give for you for free. So enjoy on my old videos, and don't forget to subscribe. Thanks.